And welcome to today's edition of the Lance Roberts Podcast right here at realinvestmentadvice.com. With us today, of course, Michael Leibowitz, CFA, talking a little bit about, we're going to talk all about the Fed today. What was said, what was not said, what the market heard, what the market didn't hear. Well, we'll talk all about that today because I'll tell you what, despite the fact that everybody was expecting a much more dovish than expected Fed, it didn't turn out that way. And in fact, the markets really took pretty much a beating after the fact is once they announced that they were hiking rates, the rest of the message wasn't nearly as dovish as what many expectations had been. And of course, that really kind of weighed on the markets, at least for right now. Now, again, markets are very, very oversold here. In fact, this yellow line that's in the kind of the background is the overbought, oversold condition. We are now more oversold currently in the short term than we've been at any other time, really since 2016. We've got to go all the way back to there. More importantly, we've had almost 3 straight weeks of declines in the markets. If we move this into looking at this chart, which is a daily chart of overbought, oversold conditions, really, really oversold here. So the expectation here is that over the course of the next few days, particularly once we start moving into the last week of the year, pretty much the inmates run the asylum. Most of your institutions are going to go on vacation. So you're going to have light trading volume here, and that tends to be buoyant for the stock market internally. So we should be able to see a bit of a pickup here over the course of the next week or so. We highly advise that you use that rally to sell into. Despite the fact that you're going to hear a lot of commentary probably over the next week about, well, there's no real risk of recession on the horizon, etc. Keep a watch on what's happening with oil prices. We've got an article coming out about oil prices tomorrow. But oil prices are telling you a lot about the global economy. Federal Express today, in their earnings announcement yesterday, said that global weakness is much more pronounced just in the last quarter than it was just a quarter ago. So the risk of a global recession has really picked up steam here lately. And of course, with interest rates falling, we talked about this a bit yesterday. Take a look at what bonds are doing in particular. Bonds are just on a stellar rally right now. The 10-year Treasury yield at 2.71%. We are very close to inverting that yield curve between the 10 and the 2-year Treasury, which again, people are like, oh my gosh, recession. It doesn't mean there's a recession immediately on the horizon, but when the yield curve inverts, remember, banks make money by lending long and borrowing short. When that yield curve inverts, well, it's no longer profitable. That's why you're seeing bank stocks in particular under a lot of pressure. Here's a chart of JP Morgan, just been under a tremendous amount of pressure lately, hitting new lows. Same thing goes for Goldman Sachs as well. All these investment banks that make money lending money under a lot of pressure right now, and that's one thing to really think about in terms of the overall economy.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at lancerobertshow.com.